Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in the last video, two videos, we focused on ETFs and Sharia compliant ETFs. If you haven't seen that, go and watch that. Really good videos to kind of get your head around when it comes to ETFs and investing in ETFs and so on. We've talked about, I think it was 13 different ETFs, so just have a look at that one first. But today we're going to switch things up and we're going to go back to stocks, and we are looking at 5 different companies that are undervalued at the moment, either fairly valued or undervalued. As you know, the markets have been going, up and up and up in the last few weeks and months. So what we want to do is look at 5 companies that seem undervalued at the moment. And as always, of course, do your research. This information is based on Morningstar valuations. And of course, you always have to do your own research and always do a bit of a margin of safety as well. So as usual, I'm going to give you the information about these companies. And again, of course, if you're interested, do your own research, InshaAllah. And again, like the video, subscribe to the channel if you haven't already. It will be really wonderful to have you also on the Discord, where you get access to the, Discord, all the buys, all the sales. You get access to all the dividends and calendars and so on, and as well as the Sharia compliant investing ebook. So it will be really good to have you there, inshallah. So let's now get started with the 5 companies that we want to talk about today. And just to kind of give you an overview, these are the things that we're looking for. So the market cap just kind of gives us an idea how big the company is. We're looking for the moat, just to see if every single company, by the way, today has a wide economic moat. That means they have some sort of a competitive advantage in terms of price, what current price is. We want to see if they pay dividends. All of them pay dividends today. So dividends, we want to see what the dividend yield looks like. The payout ratio, so how much of the net income they invest, basically they are using to pay us the dividends. The latest increase, the 5-year growth rate, we want to see how long they've been increasing that dividend, how much that dividend is, how safe it is according to Simply Safe Dividend. We want to see the profit margin, we want to see return on equity. So these 3 main things, so the profit margin, return on equity, and return on invested capital, kind of show us how much profitable the business is, as well as how much the management, how effective are they when it comes to reinvesting some of the money that we're giving and so on, or the money that they get from the banks and so on, or some of their net income. And then we want to see free cash flow. Free cash flow is important to us because that's the money the companies use to pay dividends, to buy back their own shares, to do research and development side of things, to acquire other businesses, this pay off any debt. There's so much they can do with free cash flow. Total return in the last 10 years will help us to understand how much the company, how well the company has done. But that's not going to tell us what's going to happen in the future, of course, right? But and growth estimate for the next year, so we want to see, based on these analysts, we want to see what they expect from the company in the next year, and then for the next 5 years. So per annum, are they expecting the earnings to grow every single year or decline? That kind of gives us an idea. So they use what the company has reported, and then sometimes they a little bit over exaggerate what they will do, but you have to always do your margin of safety and so on. Morningstar valuation, we want to see that as well, and fair value. So the fair value will tell us basically the intrinsic value of that business right now, what they think it should be trading at this point in time. Now let's get started. And the first company is one that I own in my portfolio, and that's Hershey Company. This is a snack company, market cap of $40 billion, wide economic moat, $189 per share, dividend yield of 2.84, the payout ratio 46%, latest increase was 15%, and the 5-year growth rate of 10%, which is quite nice. Dividend streak of 14 years, so they have increased that dividend for 14 years in a row. Annual payout, so you will get $5.48. Safety 93%, profit margin of 16, almost 17%, return on equity of 50%, and return on invested capital of 26%. That is solid so far. And a 5-year free cash flow of 1.5. Total return the last 10 years 8%. Growth estimate next year by 6%. 6% after that every single year. 6% discounted right now. $208 per share is where they think the price should be. Right now is $190 per share. So this is one of the companies that I own, and I think it's still undervalued. I will be buying out. I'm still adding to it. I still need to, I think, 3 more shares of this company to kind of round it up to, I think it was 30 shares. I'll show you at the end. So that's the first company. And the next one that we're looking at today is MasterCard. MasterCard is one of the companies that I also have in the portfolio. It has 445 billion market cap right now. It has a wide economic moat, $468 per share. Dividend yield 0.55, payout ratio 19%, latest increase was 16%, and 5-year growth rate of 17%. Dividend streak of 12 years, annual payout $2.64, safety 99%, profit margin 44%, return on equity 169%, return on invested capital of 61%, which is absolutely huge. $11 billion, closer to $11 billion of free cash flow, which is really good. Total return the last 10 years, we're looking about 21%, 17% growth estimate for next year, 90% after that. Fairly valued, 451 is where they think the price should be. 468 is where it is now, so not far off. So potentially might come back down again. If what we've seen in the last couple of days, and especially in the market, continues to happening, then of course we will see these stocks, especially a company like MasterCard, which has a higher beta, will probably come down quite a bit. Next one is Kenvue. This is the spin-off from J&J. So J&J's consumer section has been spin off, and that became Kenvue. That has a market cap of almost $40 billion. It has a wide economic price right now is $19 per share. Dividend yield almost 4%, and the payout ratio only 35%. Of course, the latest, they haven't increased it yet because it's a brand new company. They will pay you 80 pence for every share of the cents for every share of this company that you own. Safety is 70%, which is quite nice. Profit margin about 10%, return on equity about 10%, return on invested capital 13%, $2.6 billion of free cash flow. Total return, of course, in the last 10 years, the company only exists in a few months. Growth estimate for basically next year is 9%, then 2% after that, which is absolutely fine. So these companies, you expect them to grow about say 5%, 6%, 7% if you're lucky. Okay. Morningstar saying it's about 21% discounted right now. $25 is where they think the price should be. Right now it's 19.5. 25.5 is basically where they think the price should be. This is a really interesting company, and I'll show you Sharia compliance side of things. There's no issues with that as well. So the fact that it's a spin-off from everything that was the consumer side of J&J became this company. And I just need to check the debt levels of this company. Sometimes they can carry a lot of debt. Other than that, it seems really interesting. The fact that it's down quite a bit. There's not that many consumer staples companies out there that are really this good. And yeah, so that's it. Let's move on to the next one. That's AstraZeneca, another one that I own in the portfolio. This is a UK-based company, but we're looking at the US-based version of this. $208 in terms of the 8 billion market cap, wide economic moat, $69 per share right now, dividend yield above 2%, payout ratio 40%. And then I wouldn't worry too much about this because, like I've always said to you, SimpliSafe Dividend has a different information in comparison to Dividend Max. So if you live in the UK, you're interested as AstraZeneca, go and check out that. Okay, Dividend Max, you'll see different information. And they've actually increased the dividend. I think it was just today or yesterday, about 7%. I think it was, or something like that. Yeah, so just to check that out. Annual payout $1.42. Safety 70%, profit margin 17%, return on equity 15%, return on invested capital 15%. Again, $6.5 billion of free cash flow right now, 10% total return the last 10 years, 13% expected to grow 13% this year, and then every year after that for the next 5 years, which is quite nice. 14% discounted right now. Again, $78 per share. So this is one of the companies that I've been adding to in the last few weeks. I don't know if I'm going to continue doing that, but it's still undervalued, so we'll see if it maybe drops again. I think it went up a little bit today. Let me have a quick look. As you can see, I've got 40 shares, and just today I was actually, there we go, 2% up today, and I think it was something to do with I think the dividend went up and something else that was happening. Yeah, there we go. So there you go. So they've approved it 7%. There we go. So I knew I was saying the truth. Right. So that is that one. And then finally, we're looking at Air Product and Chemicals. This is another company I own in the portfolio. 53 billion market cap, wide economic moat. Right now it has a $236 per share, dividend yield of just below 3%, payout ratio 6%, latest increase was 1%, 5-year growth rate of 10%, 41 years of increasing that dividend. Say $7.08 is what you will get. Safety 95%, profit margin 18%, return on equity 16%, return on invested capital of 9%. Free cash flow right now is a negative free cash flow, which is not great. It's been there for almost 2 years now, the company, based on what they've said. So hopefully this will increase in the next couple of years. So I'm being patient, waiting. The fact that the safety is 95%, they do have enough to pay off, hopefully, and the net income will cover some of these dividends, and the free cash flow will start improving. If it doesn't improve, I'm definitely gonna look into selling this company. They're not gonna cut the dividends or anything like that. I'm not worried about that, but it's just that I don't like the fact that it's got negative free cash flow right now. Of course, the company will be reinvesting. It kind of had a spin-off, all sorts of things going on the last 10 years. So we'll see. I'm just keeping an eye on this. Total return the last 10 years, we're looking about 10%. Growth estimate next year, we're looking about 9%. Growth estimate for the next year, by the way, that was not a spin-off. I think it was merged with another company. Growth estimate for the next year, we're expecting about 7%. And Morningstar saying 23% discounted right now. $307 per share is where they think the price should be. Right now, it's looking about $326 per share. So it's got a long way to go. So that's the 5 companies that are, undervalued or fairly valued at the moment. And again, like I've always said to you guys, make sure you're doing your own research. And finally, I'm going to show you from Sharia compliance side of things. As you can see here, there's no issues with that. Of course, Kenvy has got in terms of a bit of debt in there. Same goes for air product and chemicals. The rest of them are absolutely fine, no issues with that. There you have it. That's the 5 companies I wanted to share with you guys. I hope you're enjoying this content. If you are, please like, subscribe, and of course join us on the Patreon account. Have a wonderful day. Assalamu Alaikum.